Picture this. You're a Chinese retiree in Wuhan, and you've just discovered that your monthly medical benefits have been slashed from 260 yuan to less than 100 yuan. Your life savings? Tied up in an apartment that's worth half what you paid for it. The construction company that was supposed to finish your son's new home, they've disappeared, along with his down payment. But here's the terrifying part. You're not alone. There are millions of Chinese citizens facing this exact nightmare right now. And what's happening to them isn't just a local problem, it's the visible symptom of a financial time bomb that could destroy the entire global economy. China is sitting on the largest debt mountain in human history, over 300% of their GDP. That's not just big, that's unprecedented. And while the world focuses on trade wars and military tensions, this silent financial crisis is growing larger every single day. What I'm about to show you isn't just about China collapsing, it's about the potential end of the economic order that's existed since World War II. Hey, I'm Brandon, and welcome back to My Money Mint, the channel where I dive into topics related to money and wealth. All right, let's get into it. Imagine if every man, woman, and child in America owed $150,000 each. That's essentially what China has done to itself. Except their people don't even know it yet, because much of this debt is hidden, buried in off-the-books vehicles that don't appear in any official statistics. The International Monetary Fund just revealed that China's debt has grown so fast that it accounts for more than half of the increase in global debt since 2008. Think about that. One country has been responsible for most of the world's debt explosion over the past 16 years. This isn't just about numbers on a spreadsheet. This is about ghost cities sitting empty while millions of Chinese families wait for homes that will never be finished. It's about local governments that have borrowed trillions of dollars with no way to pay it back. It's about a shadow banking system that makes the 2008 subprime crisis look like child's play. And the clock is ticking. China's government debt alone has exploded from 38.5% of GDP in 2019 to over 60% in 2024. But that's just the tip of the iceberg. When you add in corporate debt, household debt, and the massive hidden debts that local governments have been accumulating through off-balance sheet vehicles, you get to over 300% of GDP. To put this in perspective, that's higher than the debt levels that triggered Japan's lost decades in the 1990s. It's higher than the debt levels that caused the 2008 financial crisis, and it's growing faster than any major economy has ever accumulated debt outside of wartime. But here's what makes China's situation uniquely dangerous. Unlike the United States, which can print dollars that the world is forced to accept, China doesn't have that luxury. The yuan isn't a global reserve currency. They can't just print their way out of this crisis without triggering massive inflation and capital flight. Let me tell you the story of Evergrande, because it perfectly illustrates how this entire system is built on lies and false promises. In 2018, Evergrande was listed as the world's most valuable real estate company. They were building cities, selling apartments to millions of Chinese families, and promising returns that seemed too good to be true. Because they were too good to be true, Evergrande was running what essentially amounted to a massive Ponzi scheme. They were selling wealth management products to ordinary Chinese citizens, promising high returns while using that money to plug holes in their own funding and pay off earlier investors. When the scheme finally collapsed, Evergrande owed 2 trillion yuan, that's $310 billion, to banks, suppliers, and retail investors. Millions of Chinese families had paid for apartments that would never be completed. Their life savings? Gone? But Evergrande wasn't unique. It was just the first domino to fall. Country Garden, China's largest property developer, is sitting on $205 billion in debt and just posted a $27.5 billion loss, the second largest loss in Chinese corporate history. These aren't isolated failures. They're symptoms of a system that's fundamentally broken. Here's what nobody talks about. Chinese households have 70% or more of their wealth tied up in real estate. When property values collapse, it doesn't just hurt developers, it destroys the savings of hundreds of millions of ordinary people. There are entire cities of unfinished apartment complexes across China, ghost cities where construction stopped when the money ran out. But the real estate crisis is just one piece of this puzzle. The much bigger threat, comes from something called local government financing vehicles, and most people have never even heard of them. LGFVs are essentially shell companies that local Chinese governments use to borrow money without technically increasing their official debt levels. It's like having a secret credit card that doesn't show up on your credit report. These vehicles have been used to fund massive infrastructure projects, high speed rail lines to nowhere, bridges that connect nothing to nothing, and airports that sit empty. The goal wasn't economic efficiency, it was meeting Beijing's artificial GDP growth targets. The scale of this hidden debt is staggering. Standard & Poor's estimates that Chinese local governments may have an additional 40 trillion yuan, that's $5.8 trillion, in off-balance sheet debt through these vehicles. That's money that doesn't appear in any official statistics. It's debt that the Chinese government doesn't even acknowledge exists. LGFV debt has quadrupled since 2012, growing from $1.8 trillion to over $8 trillion today. And here's the terrifying part. Most of these vehicles don't generate enough revenue to pay back their debts. In July alone, a record number of LGFVs failed to make payments on short-term debt, $258 million worth of defaults in a single month. And that number is accelerating. Andrew Collier, author of Shadow Banking and the Rise of Capitalism in China, put it perfectly. LGFVs are going to be the cause of the next financial crisis in China. But it gets worse. China has built an entire shadow banking system that makes the 2008 subprime crisis look simple by comparison. They call them wealth management products, WMPs, and they're essentially Chinese versions of the toxic mortgage-backed securities that destroyed the global economy in 2008. Here's how the scam works. Chinese banks can't offer high interest rates on regular deposits because of government regulations. So they create these wealth management products that promise much higher returns. Chinese savers, desperate for yield, pour their money into these products. But here's the catch. These products typically mature in 3 to 6 months, but the money is invested in long-term, illiquid assets like real estate projects that take years to complete. It's a classic maturity mismatch, borrowing short and lending long. And when the underlying assets start losing value, the whole system implodes. China now has approximately 40% of all outstanding loans tied up in shadow banking activities. That's trillions of dollars in hidden, unregulated financial products that could all blow up simultaneously. Professor Su Yang from the Chinese University of Hong Kong warns, fund managers will find it difficult to repay maturing debt when property prices fall a lot and the secondary market becomes illiquid. Sound familiar? It should. It's exactly what happened with subprime mortgages in 2008. But perhaps the most dangerous aspect of China's crisis is that their entire growth model is collapsing at the exact same time as their debt crisis. For decades, China grew by building more of everything. More factories, more airports, more highways, more cities. It didn't matter if they were economically productive. All that mattered was hitting GDP growth targets. This model worked when China was a poor country trying to catch up to the developed world. But now, they've built so much infrastructure that additional investment actually reduces productivity rather than increasing it. Total factor productivity, the measure of how efficiently an economy uses its resources, has collapsed in China. While it grew 2.8% annually in the decade before the 2008 crisis, it's averaged only 0.7% since then. They're literally investing more money to get less economic growth. That's the definition of diminishing returns, and it's unsustainable. Making this crisis even more dangerous is China's demographic collapse. Their working-age population peaked in 2011 and has been shrinking ever since. By 2050, it will have declined by nearly 25%. Think about what that means. Fewer workers to support more retirees, less economic growth to service more debt, and a pension system that's already facing a $1.4 trillion funding gap by 2035. This isn't just a financial crisis, it's an existential threat to China's entire economic model. And the Chinese government's response? They're playing a dangerous game of extend and pretend. essentially kicking the can down the road and hoping the problem solves itself. Beijing recently announced a 10 trillion yuan debt swap program to address local government debt. But here's the problem: it's not actually reducing the debt, it's just moving it around and extending the payment schedule. It's like using one credit card to pay off another credit card. The debt doesn't disappear, it just gets hidden better. Meanwhile, China is implementing increasingly strict capital controls to prevent money from fleeing the country. But even with these controls, an estimated 200,000 people per year are leaving China, and they're taking their money with them. The wealthy Chinese who can afford to leave are already gone. What's left is a shrinking, aging population stuck with a debt burden they can never repay. Now, here's where this story becomes everyone's problem. China represents 17% of global GDP and is the largest trading partner for over 120 countries. They're the dominant manufacturer for global supply chains and consume massive amounts of commodities from around the world. When China's debt bomb finally explodes, the shockwaves will devastate the global economy. Let's look at the numbers. China consumes 50% of global copper, 55% of global iron ore, 25% of global oil, and 60% of global soybeans. A Chinese economic collapse would cause commodity prices to crash worldwide, destroying economies across Latin America, Africa, and Australia. The 1997 Asian financial crisis provides a template for what's coming. When Thailand's currency collapsed, it triggered contagion across Asia and eventually reached Brazil and Argentina. Oil prices fell to $11 per barrel, causing financial stress in OPEC nations. But the 1997 crisis involved economies that represented maybe 5% of global GDP. China represents more than 3 times that amount. A Chinese financial collapse would trigger the largest global recession since the 1930s. Emerging markets would face massive capital flight as investors flee to safety. Supply chains would be disrupted on an unprecedented scale. Deflation would spread globally as Chinese manufacturers dump products at fire sale prices. And unlike 2008, when central banks could cut interest rates and print money to fight the crisis, many countries are already at or near zero interest rates with limited policy space to respond. The US would initially benefit from flight to dollar assets, but the deflationary impact of Chinese overcapacity flooding global markets would create challenges that even the Federal Reserve couldn't handle. Japan's experience in the 1990s offers a preview of what's possible. After their debt-fueled bubble collapsed, Japan's share of global GDP fell from 17 to 18% to 9 to 10% over 2 decades. They experienced what economists call lost decades, periods of stagnant growth and persistent deflation. But China's crisis could be much worse than Japan's because China has much higher debt levels, a faster aging population, and greater integration with the global economy. Goldman Sachs analysts note that China's economic indicators now mirror Japan's in the early 1990s, but with a critical difference. Japan's crisis was accompanied by a strengthening yen, which hurt exports. China is facing deflation with a weakening yuan, a much more toxic combination. There are 3 possible scenarios for how this plays out. The optimistic scenario, which has maybe a 25% chance, involves China successfully managing a beautiful deleveraging where they gradually reduce debt while maintaining economic growth through technological innovation. The middle scenario, about 35% probability, is a Japan-style slow-motion decline with GDP growth falling to 1 to 2% annually, zombie companies kept alive by state support, and gradual loss of global influence. The pessimistic scenario, which I believe has a 40% chance, involves a financial system collapse triggered by cascading LGFV defaults, accelerating property market crashes, and social unrest over economic conditions. Here's what to watch for as warning signs of imminent crisis. LGFV defaults accelerating beyond the government's ability to contain them. Property prices falling in Tier 1 cities like Beijing and Shanghai. Capital flight increasing despite strict controls. Bank runs on smaller regional banks exposed to real estate. And social unrest over pension cuts spreading beyond isolated protests. The Chinese government knows this crisis is coming. They're trying to manage it carefully to avoid a hard landing, but the laws of economics are stronger than the laws of authoritarian control. You cannot accumulate debt forever without consequences. You cannot build an economy on unproductive investment indefinitely, and you cannot ignore demographic realities that make debt repayment impossible. For investors worldwide, this creates both enormous risks and potential opportunities. Chinese assets will likely continue declining as the crisis unfolds. Commodity exporting countries will face severe challenges. But countries and companies that can adapt to a world with a smaller, weaker Chinese economy may emerge stronger. For the United States, China's crisis offers both a warning and an opportunity. The warning is clear: debt fueled growth models eventually hit a wall. America's own debt levels are concerning, though the dollar's reserve currency status provides a buffer that China lacks. The opportunity is that China's decline could accelerate the reshoring of manufacturing and strengthen America's position in global supply chains. But make no mistake, when China's debt bomb finally explodes, everyone will feel the impact. This isn't just about one country's financial problems. This is about the potential end of the post war economic order and the beginning of a new, more unstable global financial system. The only question is whether the world is prepared for what's coming. Based on how little attention this crisis is receiving in Western media, I'd say the answer is no. China's debt bomb isn't a theoretical future threat. It's a present reality that's growing more dangerous every day. The Chinese people are already paying the price in lost savings, unfinished homes, and broken promises. Soon, the rest of the world will join them. History shows us that when empires accumulate unsustainable debt levels, the collapse is often sudden and devastating. Rome debased its currency until the empire fell. Spain defaulted repeatedly on debt from New World gold addiction. Britain's massive wartime debt led to the loss of empire and reserve currency status. China's debt bomb represents the same pattern playing out in the modern era. The combination of unprecedented debt levels, demographic collapse, and structural economic problems creates a perfect storm that could reshape the world economy. The silent warning is clear. Debt-fueled growth models eventually reach a breaking point. China may be approaching that moment, and when it arrives, the global economic order that has existed since World War II will face its greatest test. For ordinary people everywhere, understanding this looming crisis isn't academic. It's essential preparation for a potential reshaping of the global economy that could define the next several decades. The Chinese debt bomb isn't just China's problem. It's potentially everyone's problem, and the clock is ticking. Thank you for watching My Money Mint. This video idea was inspired by a subscriber in the comments. If you have a topic you'd like me to make a video about, please let me know in the comments below.